what we see here is Bitcoin's long-term performance relative to the US money supply. In other words, how much does Bitcoin outperform the US base expansion, the monetary devaluation of the dollar? And what's interesting here is that in the early days, of course, we do see how through Bitcoin's adoption, Bitcoin tended to outperform the monetary expansion, but recently that outperformance has slowed down. Now here's something I want to show you that you've probably never really seen before. At the bottom, we see how much Bitcoin tended to perform versus the last year's price. So if this blue line here is below 1, it means that Bitcoin has lost over the course of the last 12 months. If the blue line is above the white horizontal line, that means that Bitcoin has performed positively, right? That we made some gains. And so sometimes we're in a bull market, sometimes we are in a bear market. Sometimes we make money, sometimes we lose. The first bull markets were much more pronounced, as in the very first bull market, Bitcoin made 80x in return. Then came the bear market, and over the course of the 12 months till the bottom of the bear market, it lost roughly 80%. And then came the recovery, the next bull market. This time it wasn't 80x, but it was only 20x or 25x return. Then came the next bear market, the next bull market, etc. And so there it goes. What's interesting about this chart? What I find interesting about this chart is that first of all, we see the diminishing returns, right? The bull markets get more and more muted over time. But at the same time, we see that the bear markets don't necessarily get that much weaker. So the bear markets are pretty much as bad as they've always been. We always tend to sell off somewhere between 75 and 85%. But the bull markets get worse and worse. And so the risk is the same, the reward gets worse over time. The risk versus reward gets worse over time. So risk adjusted, just in terms of returns, if you don't look at any fundamentals, risk adjusted, Bitcoin gets worse and worse. Now, this is common knowledge, but what's interesting is how this is aligning quite nicely over time. What's not great, and this is what many people don't have on their radar, and this is the big decision point in the future. What's going to happen with Bitcoin long term? What's not nice is that at some point, if this trend continues, there will be a turnaround point. At some point, Bitcoin might not have anymore a bull market where we have positive returns over the course of 12 months. We might still get out of a bear market, but the bull market might be that weak that long term we might not anymore outperform US monetary base expansion. Now, Bitcoin has been created as a hedge against the devaluation of the dollar. But if the dollar devalues, say, by 20, 30, 40% because the US has to print all of that money because it has to get out of debt, and at the same time Bitcoin appreciates just to exactly the same degree, and of course we have been protected against the devaluation, but we didn't necessarily gain much more purchasing power. So Bitcoin would just fulfill its purpose, but it wouldn't necessarily give us more purchasing power over time. And this is something that I believe is very important to notice here. It becomes more and more important over time to not just hold Bitcoin, but to actually time the market. To actually buy when the market is very depressed and then take profit earlier and earlier. When is that turnaround? It might already be in August of 2028. So that's just 2.5 years from now. And this is unfortunately something that I believe most people don't really have on their radar. Most people, especially people that are 100% in crypto, that are diehard crypto fans, they believe that Bitcoin will always outperform all other asset classes. But things come in waves, right? Attention moves around, and there's sometimes asset class A that outperforms, sometimes asset class B that outperforms. And at some point, markets are saturated. And at some point, we might not see crypto in general outperform other asset classes that much anymore. The S&P 500 over the course of more than 100 years just kept pace with monetary base expansion. It didn't necessarily outperform long term. Now, this doesn't mean that Bitcoin can't grow long term measured in US dollars, but it might just keep up with monetary debasement. How quick is monetary debasement? The answer is it's roughly 6.8% per annum. So this is how much we get new dollars floating around over time. This is how much debt expands over time. This is how many new dollars devalue and thus push up all asset prices over time, including, of course, Bitcoin. But let's see what happens. Of course, I hope that at some point this long-term trend will turn around. And maybe this is a very bearish way to look at things. And maybe if you have some fantasy, it's maybe some kind of curvature in this line. And at some point, things will flatten out and we'll never hit the zero line, right? We don't really know. This is playing around with data. This is not really knowing what might really go on. Maybe in the end, this top is a bit higher, this top is a bit lower, and we never really reach zero. Who knows? But it's, I think, noteworthy to have this in mind, right? To see how we clearly have diminishing returns, how those diminishing returns are almost perfectly predictable, and how there is a good chance that over the course of 12 months, we do not see anymore the 10x returns or the 3x returns, etc. Future rallies might be much more muted than they've been in the past, and we might just go in line with monetary expansion. If you followed crypto content in the last year and you did what most other people did, then you got this kind of return. Most people have massively lost last year. And the question is this potentially a buying opportunity? Now, this is Bitcoin's long-term chart with a potential resistance line. This is simply just a curved line. There's nothing mathematical about it. But isn't it interesting how the tops tend to align quite nicely? And this gives us a potential upper ceiling. And it also gives us an idea how bear markets and bull markets tend to mute over time, as in both the upside and the downside tends to be less and less extreme. Now, have a look at this. We have here at the bottom, that is a chart of the maximum drawdown from the all-time high historically. When this is at zero, of course, we are close to the all-time high. When this is below zero, we've got a certain percent drawdown. Now, at what level do we tend to turn around? Currently, we are close to 45% below the all-time high. And we have seen only once a turnaround slightly below the current level, and that was at 50% below the all-time high. That only happened once. Maybe over here as well, but we didn't really hit the all-time high. In general, if we hit the all-time high and then turned around to revisit it again, that only happened in 2021. When was that? Have a look at the Bitcoin chart at the same time. We moved from 3.5K all the way up to close to 60K, then came back down and then hit the 67K. This secondary rally here, the rally that most people didn't have on their radar, was actually not driven by retail investors. When we look at the on-chain metrics, when we look at how many transactions appeared, when we look at the number of active wallets, etc., this grew up until the 60K mark. After that, the market tended to cool down. This secondary rally here was not an organic rally by many market participants. This was basically Michael Saylor promoting Bitcoin and giving it one more rally. So this was a very unconventional rally, and we can see that afterwards the cool down took over and we actually really entered our bear market. Are we going to see a second kind of relief rally again? I doubt it. I wouldn't know what the kind of narrative would be that could bring us again to such a rally. Most metrics right now tend to trend towards a further cool down. When do we normally turn around in a bear market like this? It could be at a level of around 64% below the all-time high. It could be, and that's what I think is more realistic, at levels around 75, 80 or 85% below the all-time high. So 85% was over here. That was when Bitcoin was still very much volatile after the Mt. Gox and Silk Road collapse. 85% was also after the minor collapse, when we had this parabolic run first from $200 to $20,000. Then we had the subsequent bear market with a drop of roughly 80%. That drop was here. COVID already saw us turning around at 75% below the all-time high. The recent crash after Terra Luna and FTX also saw us turn around at around 75% below the all-time high. So what does this imply right now? When we look at the current price, 75% below the all-time high brings us to a price level Let me expand this chart because it's quite a bit of a drop. It brings us down to $31,000. And I don't think that enough people have this potentially on their radar, that we could fall down all the way to 30K, maybe a bit above that. Now, is this going to happen? Nobody knows, but I don't think that necessarily the current levels of 60, 70K is really going to be the bottom of this potential bear market. Do you think an imminent pump is around the corner of about 40% in Bitcoin, ETH and Solana? There's always quote unquote the risk of a pump because we are currently betting on falling prices, right? If you've been following this channel for a while, you know that I'm not too bullish. I'm betting on falling prices basically since we are below the 125-day simple moving average, right? The line here in turquoise. So we make money during this drop. And there is a risk, quote unquote, of a rally to at least go above the 44-day simple moving average, right? That's this line in orange. That would not mean a 40% rally. It would mean 16%. 40% would bring us even above the 125-day SMA. That would bring us into a potential, at least medium-term recovery. At that point, we also have to look at what's going to happen with the stablecoin market cap. Is that expanding? Is then suddenly money flowing into the space again? If the answer is no, then we might also be cautious with even buying here. But in general, we are currently in a bear market. There is a chance that we go up, say, to 80K, and we'd still be rather bearish. Once we hit the 90K mark, then there is a good chance that the bottom is in and that we rally again. But yeah, I'm not betting on this right now, right? If we follow trends in general, we never sell the perfect top. We never buy the perfect bottom. We just follow according to when a trend has been established. And as per definition, right? If we wait for the trend establishment, we've already seen some kind of a recovery in the bull market, and we've already seen some kind of a crash in the bear market. And so I don't expect to buy the perfect bottom. I don't expect to sell the perfect top when following trends like this. But this strategy in general works, and that's why I use it, right? So this is when I backtest all the different moving averages. This is when we follow the 44-day simple moving average over time versus just buying and holding Bitcoin. And here's the same for the 125-day simple moving average. Since those approaches just worked very well, I just continue using them. We've already seen how Bitcoin tends to get less and less returns with every single bull market, and how the future might actually be much worse than what most people anticipate. But I want to share other comparisons. So we have looked at Bitcoin relative to the monetary base. What we see here is Bitcoin relative to the Nasdaq 100. And we've already said how both are risk on assets, how both tend to sell off at the same time, and they tend to rally at the same time based on credit in the system. Thus, we should have a look at when those are two assets that are potentially competing for the same kind of capital in a portfolio, and we have our risk on part of a portfolio. When we then decide to rather buy Bitcoin or rather buy technology stocks, when we have the decision between the two, how is actually the performance relatively speaking? And so that's what this chart is about. This is Bitcoin relative to the Nasdaq 100. And this gives us an interesting picture. Bitcoin did not outperform the Nasdaq 100 since 2021. So over the last 5 years, we had barely any outperformance at all of Bitcoin relative to tech stocks. And you took on much more risk with Bitcoin, right? If you bought Bitcoin at 60K, and that's what this peak here is referring to, and you held it up until today, you actually did worse compared to the Nasdaq 100. You lost 46%. You also got a lot of volatility, right? You got your more than 70% underperformance, relatively speaking, to the Nasdaq 100. So if your plan is not necessarily to just buy and hold, your plan is to actively trade, then it does make sense to still get in and out of Bitcoin. But if you're just dollar cost averaging, if you just hodl all your way through, and you just buy Bitcoin because of its long-term great outperformance, you might want to reconsider. Hodling was great in the early days when there was still a lot of adoption of Bitcoin. Just hodling now isn't as effective anymore as it used to be. It's just as effective as buying technology stocks. And if we now work with the assumption that there's barely any more outperformance, yes, we could make the argument that there's still a little bit of outperformance, but it's close to zero, and it's definitely going down over time massively, right? From one top to the next, we get less and less of outperformance. And so we might even make the argument that in the future we see zero outperformance or negative performance, right? This might if you make the extreme bearish case, this might even turn into bearish territory. Let me see if I find the curved line. There we go. Right, so maybe when this was a lot of outperformance in the early days and we see less and less outperformance now, maybe this turns negative at some point. And maybe Bitcoin will even long-term underperform tech stocks. I don't know, right? It's another potential way to interpret the data. And if we don't take that stance, if we just say, okay, Bitcoin performs the same as the Nasdaq 100, then still it would imply that we are maybe in a sideways trading range forever. And sometimes Bitcoin is expensive, sometimes Bitcoin is cheap. And if that's now our thesis, if we just say that Bitcoin won't outperform that much anymore, there is still potential for it to underperform the Nasdaq 100 by an additional 50% from here. And this, interestingly, also aligns pretty much with the data when we look at Bitcoin relative to the monetary base, right? We see there's maybe a potential bottom of 30 to 40K in Bitcoin. Another 50% drop from here, while the Nasdaq 100 stays somewhat stable, would bring us to the same kind of price level. So the data somewhat aligns. Bitcoin relative to the Nasdaq 100, I think, is an interesting thing to look at. It's something that most people also never compare. But most people are in both, right? They are, say, in Microsoft stock, in Google stock, in Tesla stock, and in Bitcoin at the same time. It's the same kind of investor that gets into Bitcoin and the Nasdaq 100. And because it's the same kind of investor, the assets tend to be correlated. Check this out. This is gold relative to Bitcoin, or rather Bitcoin relative to gold, right? Because some people think that Bitcoin is gold 2.0, that it's the hardest of the monies. And on a fundamental level, that is true, right? It is not expanding as quickly. It's harder even than gold. It's a potential investment that can be self-custodied, that's independent of overreach by the government, right? So we hedge ourselves against that. We can just self-custody our Bitcoin. So to a degree, Bitcoin can be regarded as gold 2.0. The problem, of course, is that Bitcoin doesn't trade like that. Bitcoin trades as a risk-on asset. It trades like the Nasdaq 100. It's not as negatively correlated to stocks. But still, it does make sense to make the comparison every now and then. And interestingly enough, we also see how Bitcoin did not outperform gold since it hit the 60K mark, right? It pretty much performed the exact same way. And if you make the exact same thesis that we already made with the Nasdaq 100, and we say that long-term it might not outperform that much anymore, it might make sense to wait for it to really bottom. It might make sense to only buy it when it's clearly cheap. That might only be close to that support, and that would imply a potential underperformance versus gold of another 36% or so. So yeah, nobody knows if those lines hold. It's all just drawing things on charts, but it does give us certain insights, right? It gives us insights of diminishing returns. It gives insights of comparative returns. It gives insights in terms of opportunity cost, because really, once you've got a certain net worth that's relatively high compared to your cash flows, then it's all about just where do I allocate my capital. If your net worth is relatively low, right? If you have, say, only 3 or 4 months of your regular income as net worth to invest, then actually what you're considering is always, should I be rather in cash or should I be invested in a particular thing? So most people just think in terms of US dollar valuations, right? I now gained that much money, I can go to dinner with that, or I can do a vacation with that, I can do that kind of consumption, I can buy a car, right? That's the kind of thoughts people have. I made not so much money, should I realize that and then start consuming it? But that's only relevant when you're only in those few months of net worth. Once you are in the several years of net worth, so I think it starts at around 2 to 3 years, right? You look at your annual income, post-tax income, and you look at how much net worth do you have, and it's above 2 to 3 years. When you're there, that's when the inflation rate, that's when the monetary base change over time matters. Because when you've got 6.8% of devaluation of the US dollar, and you're at 3 years of net worth, having that in pure cash without any returns, right? Without fixed deposits or anything like this, you have this in pure cash. Let's say it's 7% times 3 years. That's 21% of your annual income that gets reduced every year. That's a problem. Right, so you've got 3 years, 7%, so that's 21% of an annual income that you're losing when that money is not invested. The 21%, that's more than a month. That's like 1.5 months or so that you're giving away to inflation. 1.5 months per year, you're just working for inflation if your money is not invested when you're at 3 years. And so when you're at 5 years, when you're at 10 years, this matters even more, right? Let's say you've got 10 years of net worth and it's not invested, it's just in plain cash. And you've got 6.8% debasement. Then 68% of your annual income goes away to inflation. Why do I say this? I say this because it just says how much more important over time investing becomes as your net worth goes up. There's of course more opportunity. As you've got more capital, you can make more money with it, but also you're now forced to invest. If you just keep the cash as cash without any interest at all, you're basically just working for the monetary debasement. You're just working for that inflation tax. And that's why looking at US dollar prices becomes less and less relevant. And that's why the game over time becomes more and more about just figuring out what to invest in. Not whether or not we should be invested, whether or not we should be in cash or in investment. It's more about what we should invest in. Thus, it's about opportunity cost. It's about should we get into A or should we get into B? And that's why I like to look at those relative valuation charts. That's why I like to look at how is gold performing relative to Bitcoin? How is the Nasdaq 100 performing relative to gold? How are those relative things performing? Because that then gives us an idea. Is asset class A or asset class B currently cheap? That's then how we just allocate our different weightings in a portfolio, right? We want to have all asset classes at all times, but we want to potentially have more of a particular asset class when we believe that asset class to be historically cheap. And we want to have less of the asset class when we believe it to be historically expensive, relative to the other asset classes, not relative to the US dollar. And that's why I'm looking at all of those things. It's all about opportunity cost. It's all about capital rotation. It's all about, is a particular asset at a particular point in time really worth getting into? And yeah, that's why looking at Bitcoin when it doesn't necessarily outperform anymore other assets over the last 5 to 6 years even, when we look at those charts, I simply just want to buy them when they're clearly cheap. Not when they might be cheap, but then they're clearly cheap. And history tends to rhyme, right? When Bitcoin crashed already by 75, 80 or 85% historically from the all-time high. When that's historically what happened to BTC, then why would I now, after a bull market, buy already at 50%? And even if I lose the next recovery, even if I'm not joining that next recovery, that's fine, right? I want to buy the things that are cheap. I want to buy things where I have a high expected return. An expected return, I mean this in terms of statistics, right? I mean this in terms of if I bet today, what do I think is the most likely outcome when I look at the potential returns relative to their probabilities? What's my expected return? So outcome probability times return. And we look at all the potential scenarios. And I don't know where, say we've got a roulette table where the ball will fall. But if the odds are in our favor, and I do think that long term it makes sense to buy into a thing because it's comparatively cheap, then we might not recover today, we might not recover this week or this month even. But if the odds are in our favor and we play the game long enough because the thing is just so cheap, then over time I do expect that things will work out in our favor, right? Casinos long-term win because casinos have the odds in their favor. They don't know what the card of the blackjack table will be. They don't know the outcome of the next game, but they do know that when they play 1,000 games that they will make money. And that's how I think about investments. If I buy something that's historically super cheap and I do this all the time and I do this over the long term, then I do think that outperformance is very likely. That's just how I think about the market. I hope it gives a different perspective. Most people think about things deterministically. They think about, okay, we haven't yet reached the bottom, so we have to crash down. I'm not even saying that. I'm just saying that Bitcoin is not yet that cheap. And that's why I'm not buying it. I am buying it once I see it to be very cheap. And that's just measured here now in dollars, but that's also measured versus the Nasdaq. That's also measured versus gold. And that's how I fundamentally think about the dynamics of markets. Have a look at the following. This here is the prior bear market. And I want to talk about the duration of a bear market now, right? A question that we had just a minute ago. This is the prior bear market where first Terra Luna imploded, then Three Arrows Capital, then FTX. We had a lot of systemic collapses during that bear market. We did not see any major collapses yet. And this might be a potential reason to look at what could happen, right? Maybe at some point we see history repeating itself to a degree. And if we just take that as a comparison, how long could we be in a bear market for? We might not drop all the way to below 30K, because I do think there might be some kind of a slow decline of those bear markets, right? We could, in theory, if we wanted to, also draw lines like this. It's maybe not as likely of a scenario, right? But this here is again the drawdown from the all-time high to the bottom. We could play the argument that maybe the bear markets also get slightly less severe over time. But it's a bit of a stretch, but we could make that argument because the very first bear market over here also was not as pronounced. So I rather think this is like hovering around a certain level, but maybe the bear markets also get slightly less severe over time. If that's the case, right? It's not just the bull markets that get worse, it's the bear markets that also have less and less volatility. Then maybe this is too bearish. Then maybe a repetition of history is a bit too bearish. If history was to repeat itself, we would turn around below 30K. But I think maybe we won't. Maybe this bear market will be a bit less severe. Right? Maybe it will look something like this. If that's the case, how much longer could it take? We could wait until Q4 of this year. So the entire year of 2026 could still stay very bearish. The duration of bear markets historically tended to be roughly a year, right? So from here, from the top to the bottom, it was 385 days, a bit over a year. When we look at this bear market over here, that was 362 days. When we look at this bear market over here, that was 396 days. So it tends to be roughly a year. A bit more, a bit less, but roughly a year. And so we started the bear market in October of 2025. So there is a good chance that it might take at least until August, maybe October of this year, until we reach the bottom. So we are not even halfway through in terms of time. Will that repeat? Who knows, right? The sample size is very, very small, but I rather tend to go with that, right? If we haven't dropped as much compared to prior bear markets, and if also the duration hasn't been as long, then why buy now? Maybe we just stay at the current level for the entirety until we reach, say, October of this year. Maybe there won't be much more of a sell-off, but we just stay at the level. If we do, it might already make sense to buy at that point, because then, at least in terms of duration, the bear market is over and it might make sense to take first purchases. But we then have to reevaluate, right? Then the pattern, the historical pattern has changed, and we have to figure out where is the average cost basis at the time, what are the long-term holders doing at the time. We have to look at some more deep metrics, right? We have to look at on-chain data to figure out what's actually going on at that particular point in time. But that's then up for discussion if we even hit that, right? If such a scenario plays out, if the overall long-term trend changes. This clip is coming to an end, but the entire episode is available over here. Just click this to watch the video. Take your time. Yeah, just click here. Looking very much forward to seeing you on the other side. Cheers.